Hi, welcome to the first topic in management accounting for costs and control. Here we're looking at accounting information in management decision making. So really this topic is an introduction to the subject. So the aim is really for you to understand the purpose of management accounting. It's really about providing information for decision making where that decision-making's aim is to add value to the business. So the management accountant's really trying to provide information about the value chain framework and information about the flow of costs through the business so that good business decisions can be made about the business and its operations. Value chains. Value chains are a value chain is really a description of primary and supporting activities that trace the flow of a product or service from the supplier through to the customer. It clearly shows what the organisation does to add value to the product or service for that customer. So when we're looking at the value chain, we're looking at it, we're analysing it in order to both improve value and perhaps to delete options or modify it where it's not adding the appropriate amount of value. This is an important part of this subject, and you'll have to write an assignment question about this. So make sure you watch the video and look at the additional information in the online material about value chains. When the management accounting is providing information for decision making that adds value for the business, they're really looking at information that's used for internal decision making, measuring and monitoring the decisions and the performance of people, and aligning employee and stakeholder goals. You will be able to see how this happens in later topics in this subject. Management accounting techniques, or cost accounting techniques as they were then known, really date back to the Industrial Revolution. But as organisations change in size and as the competition becomes greater, these techniques have had to become much more sophisticated. So we're looking at these more sophisticated techniques in this subject and seeing how they do actually help internal decision making, can be used to measure performance and to align employee and stakeholder goals. Managers also need to have a basic understanding of product and departmental costs if they're going to react quickly to change and develop successful strategies. So make sure you have a look at the pages in the textbook on this. Management accountants are providing information for decision making. They really need to ensure that that information is relevant to the decision. They need to understand what is needed in making that decision. Relevant information is information that's future-oriented and varies with the decision that's being made. We look at this briefly in this topic, but you're going to explore this further in topic 7 in this subject. Now, we're going to start helping you understand some of the basic concepts in this diagram. This provides a diagram of the cost flows of a manufacturing organisation through to when the materials are purchased, through to when the profit is actually disclosed to the shareholders in the income statements. We start with things like direct materials. And this is an inventoriable cost. When the materials are bought, it's not treated as an expense, it's added to our inventory of direct materials. So it goes into our raw materials inventory. When we have direct labour, that is labour that's actually producing the goods, then that's not expensed, that's actually included in the work in process. So the raw materials plus the labour makes up the work in process. We've got one other item, and this is the manufacturing overhead. It could be the depreciation on the equipment that's used in manufacturing the goods. It could be the supervisor's salary. It's all of those extra things that are important in manufacturing the goods that go into actually making the finished product. So these go into work in process, and then when that work in process is finally finished, it ends up in our finished goods inventory. And all of these are items that appear in the business's balance sheet. When the goods are actually sold, that's when the costs that we've accumulated through all of this process get transferred to our cost of goods sold, and we can deduct our cost of goods sold from our sales revenue to get the gross profit on the items that we've sold. So that's a very brief introduction to this topic. I now suggest that you get in and read the items in the chapter. You have a look at the videos and the extra material that's provided in the online topic. And that's the introduction to topic 1.